Hello, everybody. My name is Bennett Tchaikovsky, and welcome. This is my take 3 on problem 14-2. And for whatever reason, this interest redemption question is totally messing me up, but I'm going to try again and see if we can get it right. So this is taken from the Intermediate Accounting 17th edition textbook, authors Don Kiso, Jerry Weingett, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, let's go for it. So over here, this is take 3. So issuance and redemption of bonds. Venezuela is building a new hockey arena at a cost of $2.5 million. It received a down payment of $500,000 from local businesses to support the project, and now needs to borrow $2 million to complete it. It therefore decides to issue $2 million of 10.5% 10-year bonds issued on January 1st and pay interest annually on each January 1st. The bonds yield 10%. Prepare the journal entry, record the issuance of the bonds on January 1st, 2019. So on 1/1/19, we know that if the stated rate is greater than the market rate of interest, of 10%, the bond will be issued at a premium, meaning that the cash proceeds are going to be higher than the face amount of the bonds. So my bond payable amount is $2 million. And now what we have to do is we have to sit down and we have to try to figure out, well, what's the amount of the cash proceeds that I receive? Then the difference is going to be to the premium on bonds payable. So to record the bond issuance, what I'm going to be going through and doing is over here, I'm basically going to say the cash payments. Remember, the bond is like an interest-only loan. So I'm going to have the principal amount of $2 million. And then my interest is going to be my stated rate. My stated rate of 10.5% times the face value of the bond. Okay, so this is going to be $2 million times 10.5%, or 210. So those are the cash payments. To bring these future dollars back to today, I'm going to use present value. So for a lump sum that's being paid a few years from now, I'm going to use the present value of $1. This is going to be 10 periods at 10%, or that market rate of interest. Over here, this is going to be present value of an ordinary annuity of $1. This is also going to be 10 periods at 10%. I use the annuity table for the stream of payments, and let's go ahead and do it. So 10 periods at 10% is 0.38554. The present value of an annuity of $1, 10 periods at 10% is 6.14457. So when I multiply this, my total, basically the present value of the cash flows is going to be 2 million times 0.38554, the present value of the future cash outflows. And this is going to be 210 times 6.14457. So the present value of the principal, present value of the interest, my total cash received is going to be $2,061,440. So right over here, I've got $2,061,440. And then my premium on bond payable is $61,440. Okay. So again, if my proceeds were less, I'd probably have done something wrong because my stated rate is higher than the market rate. and therefore the cash proceeds need to be higher. Okay. Prepare a bond amortization schedule up to and including January 1st, 2023 using the effective interest method. The effective interest method, what does that mean? Well, you have two different ways of amortizing your premium. You can do it on a straight line basis, which means I take the amount of the premium and I divide it by 10, or the number of periods where it's being paid, and then that's how I record it against interest expense. If I'm using the effective interest method, what I'm going to be doing is every year, so my date of payment, 12/31/19. Okay, so my year, my date, my carrying value beginning is going to be $2,061,440. If I was to do this in T accounts, right, my bond payable always going to be at face value. So my bond payable over here is going to be at 2 million. My premium on bond payable will be a credit of 61,440, and this is on 1/1/19, and this is also on 1/1/19. Okay, so what I'm going to do is I'm going to multiply this by the market rate of interest. My market rate of interest is at 10%. So over here, my interest expense is going to be my carrying value times my market rate of interest, or 206,144. I compare this to my cash payment for interest. My cash payment for interest is going to be the face value times the stated interest rate, or 10.5%. So my premium amortization is going to be $3,856. And then now, as I come over here, I now get to my, the next part over here is going to be my ending carrying value, which is going to be the beginning minus the premium amortization. Or 2,057,584. So as you can kind of see from this, right, I'm only required to go through and to do this for a total of, I only need to do this for a few years, but what I'm going to go ahead and do is do it for all of the years, just because I want to make sure that I'm doing this correctly. Okay. So did I do this question correctly? Well, as of 12/31/28, I've got over here $1,999,985, which is pretty close to the $2 million face value. Remember, when I'm doing a premium or a discount amortization, once I make my final interest payment, the carrying value needs to equal the face amount of the bond. Okay. So now for the fun part. Assume that on July 1st, 2022, Venezuela redeems half of the bonds at a cost of $1,065,000 plus accrued interest. Okay. So this is where I have been getting, that's why I'm on take 3 right now. So let's go ahead though, and first, I want to show what the premium amortization was through that period of time. Now, remember, when I'm going through and doing an interest payment on a bond, on a premium on a bond payable, My goal is to make this premium go to zero. So my interest payment would basically be a debit to interest expense. I'm going to debit premium on bond payable, and I'm going to credit cash. So right over here for my premium on bond payable, how much did I amortize this by? And let's take a look. So I got 12/31/19, 12/31/20, and 12/31/21. So on 12/31/19, I had a premium amortization of 38.56. Then over here, I had 42.42. And then lastly, I've got 46.66. So when it comes over here, essentially pre that July 1st, 2022, my bonds had a carrying value of, as of 1/1/21, as of 12/31/21, my carrying value of my bonds payable was $2 million plus the premium of 48,676. And so over here, I've got total bonds payable over here of 2,048,676. Now, this is where I've gotten into trouble. Okay, so what gets me crazy about this is what I'm going to try to go through and do. So if I'm redeeming half of the bonds, right, could I also write these T accounts like this? Could I say bond payable, redeemed, and I'm going to have bond payable unredeemed. I'm going to put $1 million in each of these, okay? What I'm going through and doing is I'm just rewriting. I'm rewriting history. So this is 12/31/21, 12/31/21. Okay, so I'm just showing these instead of showing it in one big T account. I'm breaking this up into my redeemed, and my unredeemed. I can also do this too on over here. I'm going to have premium on bond payable redeemed, premium on bond payable unredeemed. Okay. So again, I'm just rewriting history. And all I'm going to go through and do is on 12/31/21, so I'm going to take 48,676 and divide this by 2. So I'm just splitting this, going through and splitting this up. Okay. Now, for my interest expense, okay, so that's all I've done. So my first step was in the date at the year end prior to the redemption, I'm splitting the bonds up in 2, okay? And this is going to be, I'm doing this for a very particular reason, because this is where I've struggled in terms of going through and doing this question. Okay, so now on the redeemed bonds, I have to go through and I have to pay interest. Okay, so what's going to happen, because it tells me over here that assume that on July 1st, Venezuela redeems half of the bonds at a cost of $1,065,000 plus accrued interest. Prepare the entry to record the redemption. So what I'm going to go through and do is I'm going to say, okay, how much cash am I going to be paying for interest on this bond, on the redeemed bond? Okay, so it has a face value of $1 million. My interest rate stated is 10.5%. So the annual interest on the redeemed bond is going to be 105,000. This is annual though. So the amount of cash that I'm paying from 1/1/22 to 7/1/22, I need to multiply this by 0.5. So my cash paid for interest is going to be 105,000 at 5 times 50% or 52.5. So I'm going to credit cash over here for 52,500. Kind of makes sense. Now, what else do I need to record? Well, the amount of my interest expense is we can kind of just do a little table. The carrying value of this bond on 12/31/21 was how much? Well, it's going to be $1 million plus 24,338. If I'm doing this for half of the year, right? So my interest rate is at 5%. Okay. So again, or probably the better way to do this, my market interest rate is at, excuse me, let's take this back. My full year interest rate is at 10%. So my full year interest is going to be $1,024,338 or $102,434. But this is full year. Half year is going to be 102,434 divided by 2 or 51,217. So my interest expense for the redeemed bond is going to be 51,217. How did I get that? I took the carrying value of my redeemed bond, multiplied it by the full year interest rate of 10%, gives me full year interest of 102,434. So for half of the year, or basically the period of time that I'm paying interest up to, is going to be 51,217. So what's the difference? This is going to go to my premium on bonds payable, or 1,283. Okay. So right over here on 7/1/21, this is what I'm doing, right? So I'm paying to pay accrued interest on the bond payable. So let's go through and talk this out a little bit over here. So again, what did I do? So we made this schedule, right? We got the bond. This is accounting 1A stuff. When I come over here though to do the bond redemption, I did something a little bit different. And this is again to help me really kind of see what's happening. The unredeemed bond is going to continue on and paying interest and everything else. But for my redeemed bond, it's going to be a little bit different. So what I did was I split the bond up. I said, okay, this is the amount that we're redeeming, and this is unredeeming, or the amount we did not redeem. Okay, so over here, million, and then I also split up the premium on the bonds between the redeemed amount and the unredeemed amount. Then what I did was I said, okay, how much should I go through and pay in interest? Well, for the redeemed bond, and it's a redeemed bond only, the face value is $1 million. The stated interest rate, which is always an annual rate, annual interest is 105, but I redeemed it on July 1st. So I have to multiply this by a half or at 50%. So my cash paid for interest is going to be 52,500. Then I have to say, well, I know my cash, right? This is always going to be the journal entry we use to record interest expense if we have a premium situation. So then I said, okay, that's the amount of cash that I paid. But what was the amount of the interest? So the amount of the interest that, or essentially the amount of the interest expense, is going to be the carrying value of the bond on 12/31/21 multiplied by the interest rate of 10%, market interest rate, we don't use stated. So my full year interest is 102,434. But similar to this is only for 6 months. So I have to multiply that by 50%. And then over here, the premium amortization is essentially a function of basically the cash less the interest expense, or the 1283. Okay, so now what I'm ready to do is I'm going to go ahead and show this premium on bond payable right over here, right? So this is my interest amortization. I want to do this first before I get to the next step. Okay, so now on my books, I have over here is my premium on bond payable redeemed. I am now going to go through and redeem the bonds. So right over here, assume that I'm redeeming the bonds, half of the bonds at a cost of $1,065,000 plus accrued interest. So over here, I'm going to credit cash for $1,065,000, right? I've already dealt with the accrued interest right above. Okay. When I remove the bond, I have to take off the related accounts. Premium on bond payable redeemed. And this is going to be for $23,055. And then over here, I'm also going to have to do bond payable. The bond payable also has to come off of the books because I'm redeeming it. It's no longer a liability. Okay. So now over here, the last part of this is going to be on 7/1/22. And then over here, I have a, what do I do at this point? Okay, so I need to have a balancing entry. Going back to my favorite journal entry of all time, which is when we sell equipment. Okay, so if I have a debit that I need to balance like it is in this case, this is going to be a loss on bond redemption of $91,945. So right over here, what I'm going to do is to record loss on bond payable redemption. So if I need a debit to balance, it's a loss. Credit is going to be a gain. So I'm just going to show you something really quick, and just so you can kind of see where this was really, really messing me up. And just over here. So the question over here, they go into when they start doing this, and this is what was messing me up, is that they were saying like, okay, sorry. Okay, so this is the solution manual for problem 14.2. This is what was confusing me. So we're all good on A and B, but this is where I was getting really confused, is that they were showing this less the amortization of the bond premium, gives you the carrying amount, but they were only doing it for half of it. And that's really what kind of screwed me up. So for myself, the way I did this question, we're getting ultimately to the same solution. It's just, it was extremely hard for me to go through and to visualize the way that their solution was doing it. For me, splitting it up like this, and you can follow, this is for me. You don't have to do, like, look, the beauty of accounting is we all do things different ways. You do not have to do the question this way. But for myself, by splitting it up between the redeemed and the unredeemed, in my opinion, much easier to see the calculations. So again, that's why this video took me this is my third attempt in doing it, and I finally got it. I have a little bit of a different purpose than you have. You're watching it and trying to learn it, which is great. But if I were solving this question, if I'm ever doing a redemption question, I'm splitting it up. Because if you don't do it this way, it's just going to get too convoluted. So with that all being said, I want to thank Wiley. Don't forget to like and subscribe. And if you would like any other solutions, please feel free to ask for them in the comments to these questions. Have a great day.